Hello, everyone. Happy Sunday. Before we get started, before we bring Matt on, as always, let us know your name and where you're watching from. Drop it in the chat. Hey, Jason. London, nice. Good to have you. Oh, good. We have someone from Switzerland. Always good to have some Swiss representation. I appreciate it. Houston, Lancaster, Pittsburgh, Memphis. John, Raj, Jeremy. Hey. Nosa from Ireland. We've got some strong Texas representation here. What's going on? What's going on? All you other non-Texans better start showing up. This is going to be a Texan-only show. Syracuse, New York. Nice, David. Belgium. Great to have you. Oh, yeah, yeah. Just southeast of San Antonio. Not surprised. More Texas. What is going on? Frisco, Texas. Let me guess. Next. Dallas. Austria. Great to have you, Marcus. Rick from Ohio. Kitsana, is that Sydney, Australia? Beautiful. Good, good, good. And Mexico, thank you for being here. Finally, some Canadian representation. I mean, I'm happy to do just a Texas-specific webinar, but I was starting to worry. Hawaii, nice. 7 a.m. Hey, grab that cup of coffee. Sit down. It's time for class. Just a few seconds. We're going to get Matt on here. The Texans won't mind. Maybe Benzinga should put an office out in Texas. England, nice. Just about time for supper, right? All right, guys. It is time to kick this music, these crunchy beats down a notch. With me today, standing backstage right now, shadow boxing, getting ready to teach you guys exactly how to recognize great stocks based on fundamentals and technicals. So this is a well-rounded approach you're going to be getting here. So this is sector and company strength based on fundamentals, based on history. Also looking at the charts for patterns, price action. This is a very well-rounded session for everyone. As always, feel free to ask questions as we go. And toward the end, as always, have your tickers ready. If there's a stock that you want our educator today, Matt Maley, to talk about, keep those tickers ready. He can pull them up, give you his perspective on them. So without further ado, Matt, would you mind turning your camera on?
There we go.
Hey, how's it going?
Good, Neil. How are you?
Wonderful, wonderful. Thank you for asking. So I was just telling folks, as always, that they're about to have a great session of education with you. I was wondering if you would not mind just letting folks know a little bit about who you are and what they're about to learn from you.
Yeah, I'll do it. First, I'm just going to start with just talk about what I do, the way I look at the markets, what I try to do for investors. Number one, and then tell you a little bit about who I am and why I think I'm qualified to do these things, and then we'll kind of go into the meat of the call and just really talk about how I look at the markets, how I make the picks I make, and what really is going to help us do make the whole idea, of course, is to whoops, I just want to put my thing up there. Yeah, really, obviously make people money and outperform to maximize their returns. I mean, Main Street, Wall Street is good because the markets do tend to go up over time. But the markets tend to rally. But we do have volatile times we're having right now, and I think we're going to have for quite a bit while longer. And of course, there are times we actually have corrections and even bear markets from time to time. And all too often, too much of that traditional Wall Street mainstream kind of thinking, the whole idea is just to weather the storm, and that's great, but I want to take advantage of the storm, and that's really kind of what I try to do. So I mean, the first thing I just say about the what exactly is my, oops, I forgot to hit present here, hold on, there we go, okay. What's my goals? Again, it's to help investors and traders maximize their returns. Again, we all want to have that big, one bucket of investment that has maybe 3, 5, or even 10-year horizon, or even longer. And I certainly have a bucket of that, and that's why I have 3 different time horizons in the stock picking newsletter that we write for Ben Zinga. One of its tier 1 is just that long-term kind of 3 to 5 plus year thinking, and that's where you want a good chunk of your money in there, and it's going to sit there and compound over time. That's great. But a great way, I think, to really maximize the return is also to have more active trading in like an intermediate term, which is the tier 2 that we provide, and then tier 3, which is much more short term, which can be anywhere from just a day or two to a couple of weeks or even a couple of months. But the other thing I try to do, of course, is educate people so they can learn how to make their own picks and do their own analysis. And that's really what the trick is, because you want to know what the heck you're investing in and why you're investing it. And and some people, it's just there's just all too often they're just kind of saying, okay, take this stock, we like it for this kind of esoteric reason, and it's going to change the world, and that's great, we want those, but we put a little bit more to that, because it's very, very important over the long term that you really want to look beyond the fundamentals. I mean, the fundamental story is very, very important. We always, some people, technicians, they don't follow fundamentals at all. They look at their technical analysis, and that's fine. I think it is important to do it, to look at that fundamental analysis, because the market is always right. The problem is, for most people on Wall Street, the mainstream, they'd say that the market is always right, period. And they're wrong. That couldn't be further from the truth. It's always right eventually. And sometimes those fundamental factors diverge very much from the stock price. I mean, as I've said a million times, there's a difference sometimes between a really good company and its stock. Sometimes a really good company, its stock isn't so well because it's just become very overbought, or some it's gone too extreme, and a very bad company can become very oversold, and therefore it can rally very strongly. So we really want to look at the full picture. Technical analysis, sentiment, positioning is also a very important thing, and because we really see situations where sometimes the fundamental analysis gives you is not really very important for a short-term trade, and I don't mean just a day or two. I mean for a couple of weeks and even a couple of months. And also can give you the exact wrong implication. And I'll show you an example of that in just a second. But another thing too is that the mainstream, what they do is they're whether it be a brokerage firm or a wealth management team, whatever it happens to be, their idea is to get as much money in the door and hold on to it, keep it there. And they don't want to take too many chances. And again, that's good for the one bucket. But if you want to be more active, they always looking for confirmation on things. They don't get the key turning points because they're afraid they could be wrong, that it's going to hurt their ability to hold on to your assets. So I try to focus on the key turning points. And if you look beyond the fundamentals, that's what you can really do. Again, mainstream Wall Street makes it almost impossible to catch those key turning points. And the one great example of this, we just recently, there's been a couple of them in the last 6 to 8 months, or last year or two, is what's happened in the energy stocks. I mean, back in the August, September of last year, everybody was talking about, we're going to have another wave of the coronavirus. That means we're going to see more shutdowns. That did take place. And of course, everybody was saying fossil fuels, forget fossil fuels. They're dead. They're never making a comeback. And I said just the opposite. So we got to buy these things. This is a great opportunity. Again, I looked beyond the fundamental outlook, and I looked at the positioning in the marketplace. I looked at the technical analysis, and I also saw some proprietary measures that I look at that saw the demand was picking up. And I started pounding the table, buy this group, buy this group. And again, so these guys finally turned positive at the beginning of the year. I mean, that's great. And you know something, I think these things have further to go. The problem is, and you know, a year from now, I'll say, hey, I doubled your money in these energy stocks. And that's great. But what I'm going to be able to say is I tripled your money. And that's really that you get so much more juice. You know, you can never get the exact bottom or the exact top. Don't get me wrong. But if you get somewhere near there, you know, you can see the technical analysis, they try to get the 70% in between because they're always looking for that confirmation. That's what the mainstream Wall Street does, even on a fundamental basis. They don't believe the big turns in the market until they get extreme confirmation. And that just goes back to what I'm trying to do, try to help you. And again, we'll go into more details about how I look at specific stocks, but I just want to give you a general background here, is I don't want you to just weather the storm. And when you weather the storm, that's a defensive play. That's, that's where you're just trying to, limit your losses. And that's why we have that one chunk, the tier one, that goes for the long-term view. I mean, for instance, Chevron, which again, it's been a huge home run for us. It stocks up 40 or 50%, but we also get a 7% dividend yield. We got it when it was near its lows and was paying a 7% dividend yield. It's not paying anywhere near that now. And so when it comes in, and inevitably we'll see some gyrations in the stock like we always do, we're going to get paid to wait because we're getting that 7% dividend. So again, I'm trying to help you to take advantage of that volatility, profit from that volatility, increase your things, not just minimize your losses, but actually make some gains. That's how you really maximize your returns. Now, why would you listen to me? Well, I'll just say, that I'm not, right now, I'm besides writing these market letters, I'm the chief strategist, chief market strategist for Miller Tabak. It was based out of New York. And, but what I did before that, and most strategists, they were former analysts who focused almost totally on fundamentals. And again, that's great. And fundamentals are important. And I'll give you plenty of examples of why that is. But I worked on this trading desk, Salomon Brothers, which was the most powerful trading desk on Wall Street in the 70s, 80s, and 90s. Now, I wasn't there in the 70s, but I was there in the 80s and 90s for 15 years. And the same thing with Merrill Lynch. I then moved to Merrill Lynch, where I spent almost 10 years. So almost 25 years covering the really smart institutions, the biggest mutual funds, the biggest and smartest hedge funds, insurance companies, et cetera. And there I really learned about what really makes the market work, and not just what should happen, but what will happen, what's going to happen, what's probably going to happen, because all too often what should happen isn't really what takes place. Again, I just kind of say there, they focus too much on what should happen. And all too often, the same thing with the bank stocks this year. I started pounding the table. I had been cautious on the bank stocks for 2.5 years. Most of Wall Street spent 2 years, 2018 and 2019, telling you banks are cheap, banks are cheap, banks are cheap. You got to buy them. They're undervalued. I was like, yeah, they're cheap. They look great fundamentally, but interest rates are still going down and the yield curve is flattening. You're not going to make money in the banks. And sure enough, they underperformed for almost 3 years. But then in August of this year, late August, I saw a change with the yield curve and the long-term bonds. Important change I thought would last for a long time. That's when I, first of all, turned bearish on the bond market, thinking bond prices would go down and yields would go up. And I turned very bullish on the bank stocks. And again, mainstream Wall Street did come to that thing, and it was funny because they said for a long time it was cheap. Then 2020 came along and they turned bearish at almost exactly the wrong time and stayed bearish really until the end of this year. So they came in much later than they would have been. So just to go give you an idea of what this means for you. Now, here's the XLE energy ETF. Now, if you look down here where I got into the group where I turned bullish, okay, it's up 70% since then. Okay, now I didn't get the exact bottom. It did dip a little bit further, but I stuck with it because it didn't fall enough for it really was down very much at all. We weren't losing very much money. We always, if we have a losing bet, we want to get out if it starts to grow. And we've certainly not been perfect. We've had some losses, but we cut those off. And that's the big thing. We let the winners ride, and we have some that are up multiple hundreds of percent just in the last 6 to 8 months. And yet the couple of losers we've had, we've cut them no more than 10%. Some have even just been even down 1 or 2%. But here's when this is when mainstream Wall Street finally turned bullish. Okay, and that thing's up 20%. Well, that's great. And then technical analysis. Now, some of these guys probably turn more constructive here, but to get the absolute confirmation, these guys are only up 5% when it broke that high from last June. So, again, longer term, these things will look great a year from now, but we'll make a lot more money following that thing. Now, here's the S&P, the XOP, oil and gas. Again, it's the energy sector. And it's the same thing. Got in here, it did go down a little bit more, but they're up 105%. Okay, versus mainstream Wall Street, which is up 33%, and 14% for the people who wanted that absolute confirmation. And the thing I just want to say here, I went back to this XLE. This looks like, oh, wait a minute here. Fossil fuels, I mean, that's never going to work. Fossil fuels are going away, but they're not going away tomorrow. Okay, so we can make money on them, not just for a couple of days, but even for a couple of months. You might say, well, okay, well, how much upside does it have now? I mean, it can't make it to its all-time high. Well, it probably isn't. However, whoopsie. The chart I just showed you, oh, it's not there, I'm sorry. But anyway, I missed one of my charts. But the point is right here, even if it got up back to this level, that would still be 30%. It's all below its all-time highs from 2014, I'm sorry. So the point is, even though the fundamental outlook, the long-term fundamental outlook for fossil fuels and some of these energy stocks is not that great, it's still places where we can make really good returns. Okay, so let's really step back and talk a little bit about, how do we make those returns? What do I look at? And I said 7 areas. It's really, I'll actually mention some of them you could actually combine. So I'll go through them. But the point is, the way I look at it is, we do need to look at the fundamental analysis. What is really going on in the marketplace in the big picture? Because you can have a great call at a great company, great fundamentals. But if the overall market looks like it's rolling over, I mean, a stock like, Amazon, I mean, it's seen many corrections over the last 25 years, even though it's been changing the world, because when the overall market rolls over, even good companies see some weakness too. So I try to look at that. Then I moved on and moved to the technical analysis. And technical analysis is very, very important. By the way, I'm just going to say really quickly is that on this Wednesday on my tier 3 call, I'm going to do some kind of a beginner's guide to a technical analysis. If you're somebody who's really deep into it and understands it pretty well, I'll do more of that later on. But this is kind of an entry level type of thing to give you an idea. But the point is that momentum trading is very important, and technical analysis is fundamentally based. It's not just a bunch of lines drawn on a chart. And to make very quickly, just to say, is like, think about it. When a guy, if you're in a business that's not doing too well, and things finally, and your stock has been down for a long time, things finally pick up. Well, what do? I mean, you've had 2 years of downtime. So what do? You go in and you hire more people, you reopen factories, maybe you build new factories. That all takes time, even though your sales are going up. Well, the real good, the real professional investors, those at the big hedge funds and mutual funds, they have analysts who see this in advance. It's going to be 6 or 8 months before they reopen, get those people rehired and get those factories reopened. And so they're not going to see their earnings increase for another 6, 9, or even 12 months. Well, the big pros, they're going to see that in advance. They're not going to wait for those earnings to turn. They know they're going to turn because they see what's going on, and they buy the stock in advance. That's why we always say that the stock market tends to move 6 months in advance goes down 6 months in advance of a recession, goes up 6 months in advance of coming out of recession. And same with individual stocks. They tend to move 6 months or more in advance because it's just the way it works. It's not just a bunch of lines. There is something behind it. But you also have to look at other things like sentiment and positioning. One of the things we talked about with the reasons why I turned much more bullish on the energy sector last summer was because the positioning was ridiculous. All of Wall Street had tiny positions in the energy sector. So if you were the big mutual funds, they had very tiny positions in the energy sector. And I knew if this thing can turn around, they'll just have to add. Even if they go from, they were like 2 to 3%, even if they go to 5% holdings in that area, you multiply that by trillions of dollars, and it's going to cause a big rally. And we also saw the positioning in the futures traders, okay? Their positioning, they were all short oil in a major way. So I knew there was nobody left to sell. I mean, it was just staring us right in the face. When things get to huge extremes, whether it be sentiment, and we have sentiment polls for that type of stuff, Or, we've all heard about the AAII, which is one of the individual investors, and that they tend to be contrarian indicators. There's also the II poll, the Investors Intelligence, which measures the bullishness of letter writers, and then market letter writers. And then I look at the DSI, Daily Sentiment Index, which polls futures traders, which are the guys who are actually, trading the day in and day out. And when those things are good to watch as they flow, but when they get to extremes, they give us those big signals, those clear signals. You combine that sentiment, technical analysis, fundamental analysis, and it gives you that clear signal at the key early in the key turning point. So you get the vast majority of those big moves, because that's where most of the juice is. And of course, we will look at other things too, correlations. A lot of people will look at. I mean, one of the great calls I had two and a half years ago on the housing stocks. Okay, the Fed was still raising interest rates in the fall and winter of 2018, and of course they were tightening. And I said, buy the housing stocks. And people, are you crazy? The Fed's tightening. That's bad for housing. The stock market's going to the stock market's falling. These stocks falling. And I was like, the one, I looked at technicals because the housing stocks stopped falling. So I looked at that technical outlook. I did the fundamental work on some of the actual companies and what they were seeing. That was turning positive. I looked at the price of lumber that had taken off. And so that gave me another time. So we had these big divergences among correlations. When lumber and housing get out of whack, it's usually lumber is usually the right one. And I saw that in advance. We got into that group very, very early. So those have and we also see correlations among the dollar and what's going on in emerging markets. There's a contrarian indicator there. The dollar and what happens in commodity prices. That's a very good, another one that we want to look at. So there's all these sorts of correlations. The correlation between Cat Tractor and John Deere. Cat Tractor is one of our top picks. The situation in the reopening trade is going to be great for construction, Cat Tractor and John Deere. But so they're both going to go up. But the thing is, John Deere is so far ahead of Cat Tractor right now. Cat, we think, is going to play catch up. It's already up very nicely since we picked that stock just a few weeks ago. And then there's also in the tier 3, which is much more short-term oriented. We do a lot in terms of options. Look for those opportunities where things could pick up and really it gets a big bang for your buck. And we can make, instead of making, maybe you get a home run with a 70 or 80% return in 6 months, you can get several 100% in just a couple of weeks. In some cases, we just had this last week where I made a call on the Apple call options that rallied 250% in 24 hours. And again, politics, I put that dot there because there's a lot of other issues, but I always try to look at politics. And I'm not saying, and I never take a political stance. I don't care what anybody's politics are. That's not I'm not saying what you should vote for this guy or should vote for that woman, whatever happens to be. You want to be, I just want to see what is going to happen. How will that impact the markets? I mean, right now we're looking at the geopolitical side of things with the tensions between the US and China. Of course, what's going to happen with any kind of effort to, in front of the companies, that social media companies, are they going to put more restrictions on that? So there's the political aspect of things. And so we looked at that. So we combine all these different areas to come up with some of the picks we have. Now, before we move into the picks, I'll just say last thing I just mentioned, I talked about how I've turned very bullish on at key turning points. I turned bullish on energy and the bank stocks. At the beginning, at the end of the summer and early fall last year. But other big ones, I mean, last March, as I said, where did I go? Here, it's the first one, of course. Last January and February, I was pounding the table saying things that the market's priced for perfection. This thing with the coronavirus is bigger than people realize. Raise cash. I'm pounding the table. I even use the term. I'm pounding the table, raise cash. And then I turned bullish in March. I said, let's use some of that cash. Now's the time to go into it. It worked out beautifully. Same thing with commodities. Commodities was in a 9-year bear market. But from what I saw from the technical analysis and from the fundamental turns I was seeing in some parts of the world, I turned bullish on that sector. And it was funny because I didn't turn totally on oil yet. I waited a couple more months because I needed to see more of my measures really turn positive. But that was a general call. Again, much earlier than the rest of Wall Street. And I mentioned on the treasury market at the end of the year, I mentioned the banks and earnings, banks and energy stocks. And I'll leave just the one last thing is on those FANG stocks. I turned negative on the FANG stocks at the very end of August of last year, called for a correction, and which worked out very, very well because I thought cause the rest of the market to correct, which it did. People forget we had a 10% correction last September and a 12% correction in the NASDAQ. But after that came out, I said, no, don't jump back into the FANG stocks. Those are not going to lead us out this time as they had in previous bounces. And that turned out to be very prudent. Instead, I said, get into the chip stocks, And that worked out very well. So anyway, I just wanted to move on and just talk about a couple of the stocks we had and worked out very well. I'm sorry. First of all is Microvision. This has been our biggest winner. I mean, the stock is up 573%, and since we picked it. But again, to talk about how, first of all, I looked at it on the macro picture. The macro picture was looking good as I'd seen in the past. Every single year, no matter who wins the elections, Democrat or Republican, the market tends to rally after the election into the end of the year. So I like that on a macro level. On a fundamental basis, I love the story with Microvision. It's unbelievable play there. It had what they have. Number one is the biggest thing is LiDAR. And LiDAR stands for laser radar. Okay, and those laser shots that go back and forth. That's the only way a self-driving vehicle can work. That's the only way robotics can work. That's the way these new vacuum cleaners work. This is unbelievable upside potential for many years to come. But they also, as a double kicker, that these smart glasses that everybody looked ridiculous a few years ago, people thought might be the next big thing. Well, Tim Cook is now saying it is going to be the next big thing this time around, because Microvision has a new display thing that is much smaller, and then therefore you can have these glasses that are going to be much more stylish and not look like you're in some sci-fi movie. And so there's a couple of different reasons to like it on a fundamental basis. Then on the technical basis, I can't really see as much here, but it finally made a higher high. It had come down here. I liked it. I was watching it. I should have put a chart a little bit further back because the stock had come down a little bit. And then the last thing is that the positioning, the short interest in the stock was not a huge short interest. It's not the GameStop play. I'm not a big believer in you can play on those, and we've made some money on those, but that's very dangerous. But the short interest can still, when the other things combined, to give you a kind of situation. I saw the short interest was high and it was building as it came down here, and that's another reason why. So these things all combined, and it's been a huge home run for us. Now, as that's the pick, it's still our number one pick. It was our pick at the end of the year, saying this is the pick. This is the something that's going to change the future and look in just a few months. But also, I just want to say on our tier 3 call, we made a couple of different calls. So here, when it got to here on the tier 1, we just said we're just going to stick with this. We're going to let it ride. But on tier 3 call, the short-term traders, I said, take a chunk of this, take half of your position and take profits. I think it was up 240% in literally 2 weeks. Or 3 weeks, 2 weeks, whatever, 2.5 weeks. That's a huge gain, huge home run. But I love it long term, so I didn't want to take full profits. And we went down here and we bought, and I said, walk away, let's sell half, and we'll get back into it. It gets down back near $5. Sure enough, just 2 weeks later, it had fallen back down. I said, okay, it's back at $5. Let's get back in. And we ran it all the way up to here. It rallied another 355%. It was up 700% from where we first bought it. But of course, we had a bigger gain because we sold half and got right back into it. Again, the technical analysis that I do told me it was ridiculously overbought. And I said to sell half. I said, we'll buy back some at 15. So when it got down to 15, we bought 25% to make our full position a 75% position. And we held on. And right now, we're still holding on to that, a little bit of cash, because I'm a little concerned about the overall market may pull back. But see, this is another way to maximize your returns. We have a long-term call, a basic call that we're going to hold on. We're going to hold on to this for years. We think it's going to be, it's already up now it's up 500%. But again, our return has been closer to 1,000% because we've been able to trade around it. Again, I don't want to get too much into these names, but here's one another one that's done. It's up 114% since we picked it. This is one I have not traded around. And the reason I didn't trade around that one is part of the reason why I like it. I loved it because I love the financials coming out of September. This is where I liked it. I liked it on a technical basis because it made a new higher high. On a fundamental basis, I loved it because they really had a good, diverse portfolio, unlike in the past when during the tech bubble, they were very concentrated in the tech area. Now they're much more widespread and more spread out. And they're also a takeover candidate. I knew that a lot of different money managers were being taken over. Invesco, of course, one of the big money managers in the country. And that's why I'd never wanted to take any profits because, I said, geez, if I had taken a profit here, we could have bought it back a little cheaper. Okay, fine. But everybody's talking about this, the takeover. The people, their biggest holders, their biggest institutional holders are saying it's a great takeover candidate. I don't want to be taking profits on thing and have it open one day 30% high, another 30% higher because they've been taken over by some other big mutual fund or something like that. So, so there's just another idea. I can go on to others. I don't want to go too long. I'm just rambling here because I do want to go into some stocks. And some other stocks that you guys want to talk about. Fluor Corp, I mentioned this one because it's only up 27% only, but we've only had it as a pick for a couple of weeks. And again, it fell into that thing where I'll tell you the story behind Fluor is that they are a construction company that have been building in the energy sector for years, but they've been smart enough to diversify. First of all, they're into construction in the green energy area. That's very good. And they've also moved in the last couple of years. They saw this coming with the infrastructure situation, and they're all just in regular infrastructure, bridges and roads. And a lot of people, these infrastructure names have had huge rallies. Fluor Corp, people don't realize that this is also an infrastructure play. So I think it's got a lot further to go. If the overall market pulls back, it may come back into. But again, this was the reason why I picked it. I'm sorry, it was kind of funny. And I don't have it here, but the reason why I picked it, even though it wasn't breaking out, but I doubled down on it up here when it broke out above its high. The reason I bought it here, and I don't have it on this chart, was that its MACD chart was making a nice curl up at a higher level, at a higher high. Again, the MACD charts, RSI charts, head and shoulders, that's something I'll discuss on our tier 3 call on Wednesday. And what I do with that tier 3 call, I talk for 15 minutes or so about the markets and some of the picks and some of the really short-term calls. And sometimes it goes to 20 minutes or even a little longer. We type up a review of it and stick it up and send it to you guys, and you can get an idea of what's on that, because we do tape it and you can listen to it later if you can't listen to it. It's Monday, Wednesday, Friday at the noon hour. But this time on Wednesday, unless the markets, anything can happen nowadays. If the market's going crazy, we'll just talk about the markets. But if we have some time, we're going to take a half an hour, 45 minutes to go over kind of a tutorial on the basic side of technical analysis. Now, Neil, I don't know what I can talk about a couple of the stocks I like here right now, or we can and talk about why I like them, or we can go into Q&A, whatever you'd like to do. I know I've been rambling here for about half an hour, so I don't know how you want to play it.
Yeah, so I think, as always, we let chat run the show for us. So we've got some tickers that we want to see. So Joe, I got you. Joe wants to see Peloton.
Share screen. Yeah.
Oh, and we've got IT support, the young Maley Jr. here. Probably not getting paid.
Okay. He does. I do pay him, actually, as a matter
of fact. Okay. Wow. Wow. That's a cool dad.
Oops. He's gonna help me here.
So we'll start with Peloton,
yeah,
and then
I'll talk about it, but there you go.
And then just so you guys know, so Ned, I see your question about MACD and RSI. So I think with Peloton, it will be great. We'll just pull up the RSI and MACD oscillators. Actually, I'm not even sure if MACD counts as an oscillator, but that's neither here nor there. We'll pull up those two indicators.
What's Peloton symbol? I missed the symbol there. PLTN?
No, but Piton.
Oh, Piton. I'm sorry. PTON. Why you'd think I'd know that one, right?
Yeah, PLTN makes more sense than PTON to me.
I don't know. I have the but anyway. Now here's a stock. This stock is again. Before we say, I just want to say one thing about the overall market. I'm a little concerned about near term. I say near term, but I was very, very bullish going into for 4 or 5 months going into the end of the year. Into January, I was very bullish. As we got to the very end of January, I'm a little more cautious, and the market certainly has flattened out. And my big concern right now is that the Fed is changing policy. I don't care what they tell you, okay? I mean, we heard it all over CNBC and Bloomberg. By the way, I'll be on CNBC Friday afternoon, or Thursday afternoon about 2:45 or so. But anyway, they're talking about how the Fed doubled down on their dovish stance. They only doubled down on their saying that the short-term interest rates are going to stay low. What they also reiterated is that they're going to let inflation run hot. That's the same thing as saying we're going to let long-term rates run higher. Okay, they also ended the thing for the banks to be able to how much of collateral they have to keep on tab. That they had this emergency thing that they put on last year that's being taken off at the end of the month. It comes to expire. They did not extend it. And it's just and of course the Fed is already talking about a tapering back on QE. It's a very gradual, very subtle. Don't get me wrong. This is not going to be a major taper tantrum, but they're telling us there's no question they are more hawkish than they were at the beginning of the year, but not a lot more hawkish, but a little more hawkish. So we need to be a little bit careful on the markets here. But let's go on to the thing. So this is at such a key level right now. Look at the right here. We see the 200-day moving average. It seems to be holding that 200-day moving average. That's great. It needs to do it. It's vitally important. The stock is coming from an oversold condition. That's positive. But
hey, Matt.
Yeah.
So right there, you got to RSI. Can you explain how RSI works and what you mean by oversold?
Absolutely. I'm sorry. Relative strength index. And it basically, we talk about it just tells you about the strength of the selling and the strength of the selling or buying or selling interest at any certain time. And in other words, they look at the volume and the number of shares on downticks versus upticks, and then on daily and weekly basis. And it gives you an idea of how intense the buying or selling is. And when the selling gets really intense, that means people are really selling a lot of volume on those. They're hitting bids. They're selling on the bids, and that tells you that when it becomes to an extreme, it means that it's getting washed out. That the sellers are basically done. There's not much more they can sell. And same thing with the short sellers. The short sellers have kind of done what they can do. Now I'm just going to pull this up.
So Matt, for RSI, you've got oversold, right? What number do you hit when a stock is oversold?
Okay. Now look at the chart here. You see where the red line is up there, and the green line's down there. Okay, the red line, and of course it'll stop. That means it's getting overbought. Stop buying. That's why they use a red line on that, and that is at the 70 level. Okay, that's telling you it's getting quite overbought. Now you see here, right here, it got incredibly overbought. It was a great time, especially on a short-term basis, to sell it. Okay, this is a daily chart. If it gets overbought on a weekly basis, even more so. But you can see that it saw a decent decline there. I mean, it doesn't look that much on the chart, but on a percentage basis, if you sold it here or shorted it there or bought some puts there, you made some real nice money. Now here, same thing. You had a situation where the green, buy it now. This is getting oversold. That's why they make it green. That's at the 30 level on its RSI chart. So 70 is a sell, 30 is the buy. I would just say, though, is that you want to look back on a longer term basis and try to tell you whenever you look at a stock, because some stocks, and I'll just pull one up while we're here, while we're talking, that I think is one I do not like at all right now is Viacom, CBS, great company, all that stuff. Look how overbought it is, okay? Look how overbought it is on a weekly basis. 95. It's never been this overbought. Never. Not even close. Now, this has been one of those GameStop people where they've been playing. They look at that. Look how overbought that is. You can look at how far above it is above its red line, way more than it ever has been. And look at that parabolic move straight up. This has been one of those things where it had a lot of short interest in the stock. So if you short the stock, you definitely want to have a tight stop. But a lot of that short interest has been walked off. You do not want to be buying the stock up here, okay? If anything, look to buy some out-of-the-money puts. That's one of my calls in Tier 3 right now, is to buy some out-of-the-money puts on Viacom that go out a week or two, because look, it's going to see the same kind of similar drop as GameStop did, 20, 30, 40%, even though it's a great long-term company. And they're not going out of business. We don't have to worry about them, but it's just that kind of a play. So again, going back to Peloton, so again, it's coming off a nice oversold bit, so that's good. It's holding its 200-day moving average, but we do have to be worried about here. If it breaks below that, so it's kind of, it is at a key technical juncture. If it breaks below that 200-day moving average in any kind of meaningful way, you can see how well it's held up over the month of March. If it breaks below that level, it's going to get a lot of those momentum players are going to dump the stock. So I guess my point is that if you're buying it here, have very, very tight stops. If it runs above 120, that's going to give it a nice little higher high. I'm glad I got this here. A nice little higher high. Oops, let's get rid of these. That's going to get rid of two moving averages there. Sorry.
While you're doing that, Matt, really quick, Brent's asking, how do I find that stock chart? So what we're looking at is the Peloton chart over a year's worth of time, and then those candles are these daily?
Those are daily, yeah, daily candles charts, and you can see, well, something. I'm gonna zoom it out, and you can see there's little lines on each one. This is just a very small. Oops. But see how these little lines are there? Okay, that's where it opened, and that's where it closed. So that's where it closed that day. That's where it closed that day. That's where it opened that day. So that's the range of the day. That's where it closed, and that's where it opened. And usually, when most charts, you can click on it, and it'll tell you. See, it opened at 78. And it'll tell you its high and low of the day. Okay, so that's what those charts is. Each day is the range of the day, and they put little flags on it to tell you, where they closed. The most important thing is where they closed.
And then we're getting the question, what software is the presenter using? This is the Bloomberg terminal, which is used by like pro traders. Yeah. So it's very expensive.
Yes.
Matt has
this one's like
the good stuff. $3,000 a month, which so it's quite expensive. Most folks are using something like Benzinga Pro, TradingView, or StockCharts.com.
Benzinga Pro is fabulous. I've just been using Bloomberg, and I'm going to start shifting over because Benzinga Pro is a fabulous product and can basically give you the same type of charts. It absolutely can give you the same type of charts. But I've been using Bloomberg for 25 years, and so it just kind of it's second nature to me. So that's why I use it. But yeah, Bloomberg Pro is fabulous. And again, you look at these. It's a great way to look at the Benzinga Pro and others are a great way to look at charts, and you get a good idea of what's going on. And that's, again, what I'm trying to do is help people learn through experience, not just you can show a bunch of examples, but when you see it in real time, it's really helpful.
Hey, Matt, how about another ticker?
Okay, let's hear it.
Let's hit. I've been hearing a lot about this one, and I haven't looked at it myself. GEVO.
Okay. Boy, this stock looks pretty good here. I mean, it's here, again, you're looking at it technically. Now you can see how the yellow line is the 50-day moving average. I'm going to get the 100-day out of there so you can see it. There we go. Okay, now you see how overbought it got? See, just because it got way overbought doesn't mean it's going to go down for a long time. It just means it was, it's a daily chart. It just means it's going to go down for a while. Okay. Now you might think, well, geez, it really barely went down. Why would you even bother selling it? Well, move from $5 down to $3, huge move percentage-wise, right? And so people, if you sold that when it got to extremely overbought level, and then it got, it made a great time to buy it. And the same thing here. It got up to here, it pulled back for a couple of days. But when it gets a stock that's this volatile, you need to be a little careful about playing it day to day. But look what we have here. Again, it's got above its 50-day moving average. One of the key things I do want to talk about with technical analysis, whenever a support or resistance line is broken, if it's broken by a couple of pennies, it means nothing. You want a meaningful break. We frequently get head fakes where it breaks above it breaks above resistance level for a day or 2 days, and then goes right back down, or it breaks below a support level and then goes right back up. And so you got to be careful here. So see how it got a little above it? That wasn't enough. It's very tiny, but it's back up to it. And what this is telling us here is a very, very much a potential a higher low. One of the very, very simple things in technical analysis is looking for positive things when you get higher lows followed by higher highs, and very negative when you get lower highs followed by lower lows. This has a potential being a higher low. So in other words, this thing finally washed it out. The RSI got right down into that bottom level, that 30 level, and it started to bounce. So that's good. If it can take it one step further. So I'm looking right now at if this thing, the momentum players, again, very much a momentum name, $10.42. That was the high. I can see that in the upper left-hand corner. It tells me what the high that day was. And you break above that in any kind of meaningful way. Again, if it's 1046, but it gets into 1060, that type of thing, it's going to be very, very bullish. And again, now, yes, it's no longer crazily oversold, but it's not overbought either. And so it's definitely going to catch some upside momentum if it breaks above that level. And look here too, is that when it was how crazy overbought it was at the high earlier this month. I'm going to go too far back because there we go. You can see how it got way overbought. So that was a good time to sell it. You buy it back now. Okay, this thing is not, it's worked off, even though it's not oversold, it's worked off a huge amount of its overbought condition. So if it breaks above that 1050, 1060 level, it's going to see a nice run. So again, you want to be careful, use that tight stop. And what I would use, going back to the, oops, I had the daily chart. So go back so use it says weekly, but that's the daily chart. I'm sorry. There we go. Good. Okay. So now, and so what you do is you have a stop. You risk management. How important is that? It's very easy now. If you buy this thing, okay, now it's 20%, so you need to be careful. So you never want to take more than a 10% loss anytime. It gets down 10%, get out of it. Move on, because you let your winners ride. They go up hundreds of percent. And if you have 7 out of 10 are winners, 3 out of 10 are losers. That's great, because your 3 out of 10 lose 5 or 6%, and all of your winners are up 100% or 7%. You win in a big way. But you do know, and I'm saying here on a near-term basis, here, look at the stock. It bottomed at the same level each of the last 3 days, right here in that $8.50 range. You break below that, the stock's going to get hurt. It's going to get hit. Volatile stocks can be, can turn on a dime. So kind of a critical juncture here. If it can break out here, which it looks like it wants to do, it's going to be very bullish. It rolls back over and breaks below 850. It's going to be a big problem.
Okay, so we've been asked a couple times, so I want to make sure that we get to it. But I don't know if it applies to this situation, but how are you using MACD?
Yeah, great.
And what is it?
Okay, let's look at. Okay, MACD. I'm sure everybody wants to know anyway, so we might as well do a good old Bitcoin. Let me just pull it up here. MACD. Okay. Now, a MACD chart. Many people have heard of golden crosses and death crosses. And what those are, if you haven't heard of them, it's a golden cross is when the 50-day moving average, a rising 50-day moving average, crosses above a rising 200-day moving average. Sometimes 50 days rising and the 200 days falling, so it's not as compelling. But still, when the 50 rises against the 200-day moving average. And a death cross is just the opposite, when the 50 rolls over and crosses below the 200-day moving average. And that's usually, again, that takes a while. That doesn't signal a top. That confirms a top, because it's already started. Those moving averages wouldn't roll over unless the stock was already rolling over. So it gives you confirmation. The MACD chart is more short-term oriented. It tells you, in this case, it's the 5 days. It's the 9-day period versus the 12-day period. In this case, it's the 5-day moving average versus the 12-day moving average. If we were looking at the weekly MACD chart, it would be the 9-week moving average versus the 12-week moving average. So it's shorter term. But so those can be good indicators. But look at this thing with Bitcoin, where it's such a key level here. This thing has been making nice, higher low, higher high, higher low, slight higher high. But we're not sure so what's it going to do now? Is it going to make that another higher high, or is it going to roll back over? But look at this MACD chart. It made a nice positive cross. Look how far it rallied up. Look how far it rallied after this positive cross. Oops. Okay, it made a positive cross there.
So your positive cross here is we've got the white line versus the red line, right?
Right. The white line is the key. That's the that's the key, the one to watch. It's the white line versus the red line, and that's the shorter trade moving. That's the shorter moving average versus the longer one. Okay. Mm-hmm. See what happened when it broke below it. Okay. Sorry, I keep talking, but see how it made how big run there. Very positive run. Same thing happened here. It broke above it. Look at how the price took off. Okay. And look what happened each time it broke below it. Well, now we're at a key, but what I love here is the most recent time it broke at a higher level. Here it had a positive cross at the same level. This time it's crossing at a higher high. That should be very bullish. But then all of a sudden it rolled back over. So we're right back. What's it going to do here? Is it going to cross back below, or is it going to take off? So what I'm watching right now, if we break above the recent highs, especially during the week, the one thing you have to worry about is this high we got here in Bitcoin happened over the weekend. Unlike everything else, Bitcoin and all these cryptocurrencies trade over the weekend, but not as many people are involved. You like to see the big technical moves during trading, U.S. trading hours. Even overnight trading during the week isn't as helpful. You really want to see how it trades in U.S. trading hours. This thing breaks above those highs next week during trade, it is going to explode to the upside. It's going to go to 75,000 so quickly you won't believe it. But it's a key technical juncture. Why take the chance? Wait till you get that confirmation. If I look at this this chart on a closing basis, which most technicians really like to look at, that's the level I'm looking at right up there, just above 60,000. I'll give it the exact level. It was 61,070. So basically 61,100. You close above that any kind of meaningful way, this thing's going to take off because of what I just showed you in the MACD chart. Not only is the asset making higher lows and higher highs, the MACD chart is making higher lows and higher highs. That's going to be very bullish. But again, we need to be a little careful because last week's action was a little disappointing.
All right, so we're just about getting to time. So let's just hit a couple tickers on a little rapid fire session. Palantir, PLTR.
Okay, let's get that. Okay, here now this one it's very interesting. So let's see you need to be a little careful. You know, it's again another key juncture. And if you can see, I mean, one of the most important, even though it's one of the easiest ones, and sometimes you think, well, it's an easy one. It's not one that's all that important. But if you can see here, I'm trying to get a thing, but if you can see how here in November, that's the left shoulder of a head and shoulders pattern. That's the head, and here's the right shoulder. The neckline, I'm trying to draw it, but I'm getting a circle there, but you can see the neckline comes, there it is, boom, there's the neckline, okay? I'm going to get rid of these moving averages. I'm going to get rid of the one of them. Hold on. Okay, there we go. If it can break above its 50-day moving average, which provided resistance before, that's going to be really bullish. Okay, it's going to show that the head and shoulders pattern is a failed head and shoulders pattern. There's nothing better than a failed head and shoulders pattern. The problem is there's nothing worse than a successful head and shoulders pattern. So if it breaks below this level here, the neckline, which, you know, 21 and a half, $21, 21.25, right in there, that's going to be a big problem. So you can, if you make a bet here, make sure you have a stop out level. You break below that neckline, okay? That's going to be, basically $21. You want to get out of if you're long, you want to get out. If you're short, and it gets above the 50-day moving average, you want to get out. But if you do get long and it breaks above that, add to the thing. One of the biggest things I could tell people, don't be afraid to add to long positions at higher prices. So many people say, oh, I wish I bought more. Why didn't I buy more? Well, why don't you buy more now? I mean, think about it. If you buy this stock now at $24, all right, and then it goes to 28 and you buy more as it's breaking out, your average price is 26. That's great. You have a price of 26. Your average price is 26. The stock's trading at 28, all right? You have a profit. You can now put a stop out level at 26. You are guaranteed not to lose money. Oh, I mean, we could have a gap opening and stuff, but basically you're guaranteed not to lose money, all right? If you add to a stock on the way down, it's okay. If it gets to a level, you buy a little bit more, but if it drops from 20 to 22, I say 24 to 21, and you add, okay, now your average is 23 and a half, but the stocks, you have a losing position. So if it breaks below that average, you're screwed, okay? You can add to a short position as it goes down and add to a long position as it goes up, but do not double down in a big way. Get out of the stock and start again in another more advantageous place. Do not do there. So again, I'm kind of got on a tangent there. I apologize.
No, that was that was really great. I've been looking at Palantir a lot, and I have not thought about it that way. So it's super helpful for me. I just want to say.
Yeah, I mean, and you look at it, you can just look at that line, that neckline that I talked about in the 50-day. It's been in that tight range. Whenever a stock gets stuck in a range, of course, the longer the range, the big. But here, look at this. It got stuck in a range right here, and when it finally broke out, look at that. Look at that percentage. I mean, you know, it goes from 35 to 45. So you get 20% in 3 days, and if you have the options, you made several 100%.
So let's move on to two more. One, we've got to do Tesla. It'll be probably another 40 or 50 years before we can stop talking about Tesla. I don't know, depending on how things go. We'll see.
The key thing about Tesla, and I want before we talk about its short-term potential, is we have to remember there are great. Last end of August, I was on CNBC and they asked me about it, and I said to Tyler, I said, I wouldn't buy it with your money. And I said, this stock is so overbought. See here, look at that RSI. Look how ridiculously overbought it was. The stock, that doesn't look like a lot. That stock went down 30%. Okay, and that's why I said this is ripe for a 25 to 30% correction. Now, believe me, I don't get them all right. I don't pretend to, but we get a lot of them right, a lot more than I get wrong, which is good. But the point is, even if Tesla is going to change the world, okay, they're going to have downdrafts. It's going to fall 30% sometimes. It's going to fall 50% sometimes. Amazon has spent the last 25 years changing the world, and guess what? It had a 90% decline once. I don't think Tesla's going down 90%, but it's also had two 60% drops. It's had 24 of drops of anywhere from 20 to 50%. So good companies, the stocks get too stretched. Even if they're going to change the world, they still see short-term pullbacks. So they're so great. You want to own like Kathy Woods and own Tesla and just own it. That's great. But I like to say have a chunk. If you like it on a long-term basis like that, have that big chunk, but have a portion of it where you can trade around it. So again, I got off on a tangent there, but to really talk about what I think about it near term, though, let me just get that out of the way so you can see. It's coming off the oversold level. The problem about this stock, though, is that it's getting. I didn't want to do it the weekly chart here. See, it's still not crazy oversold. And the reason why I mentioned this is it goes back to that thing I mentioned with the Fed being less conducive right now. I'm a little worried that they're not going to be able to, if liquidity comes out of the market a little bit, this will be a problem for the stock. And also we have to think about positioning, okay? The stock, there's a reason why Apple and these other big FANG names aren't doing well right now, is because they were way over owned. And now they've been dead money for 6-8 months. And so these big institutional players are saying, I can't have an outsized, an overweighted position in Apple anymore, even though it's a great company, because it's weighing on my performance. Now we're looking at the same thing with Tesla. It's only been 3 months now, but the stock's been dead money. And so the key, so again, this is what I'm looking at right here. Look at these highs right here on a short-term basis. How many days in a row, right? 7. So basically we were looking at 700. Again, 701 doesn't work, but maybe 710. That's going to be bullish. It's going to finally it's going to take us above the short-term trend line going back to the January highs. And that's going to be very bullish. If you break below, again, I'm going to do it on a closing basis here. Hold on. Boom, GP, bang. But again, if we make a lower low, look out. You want to take major profits. It's like, oh, geez, I own this thing at $200. It was up at 700. Am I really going to sell it at 563? No, I'm going to wait for the next bounce. This is all the makings of a lower high. If it follows it with a lower low, it is AMF. It is big trouble, and it's going to get absolutely clobbered. So be very, very cognizant of that 563 level. You break much below that, and the momentum players are going to dump the stock. But right now, it's looking okay. Again, 700. Get a little about 710. That's going to give it a clear way. So it's another one of those stocks that's at a key juncture, and it's hard to know which way it's going to go. But I'm a little cautious because it looks like it's making a higher low. I'm sorry, a lower high.
Oops. All right, there you go, guys. Let's look at another Kathy Wood owned name, NNDM, Nano Dimension, NATO, Donkey, Monopoly.
This is the same situation. Again, it had a nice bounce off an oversold level, but here, and this is dicey. She's a rock star. She's doing really well, and I have huge respect for her, for Kathy Wood. But this is setting up in a very dangerous way, because we made a double top here. We can see it's very easy. Double tops are very are very tough. When you get a confirmation, and we got that when it made a lower low here, it made a lower low, broke below its 50-day. So it gets below its 50-day moving average. Let's get rid of that 100-day out of there. 100-day moving average actually can be very helpful, but at times, but frequently it's not either. So here we go. So we made the double top. That's confirmed by the lower low. Ooh, that's not good. Comes down here, it gets oversold. So it does get the short-term bounce. It got down to that 30 level in the RSI. It rallies back to its 50-day moving average. Looks like it's failing there. And it's starting to roll back over. So that looks like it's creating a lower high. Again, you break below those lows on the closing basis. It's going to be, I mean, the momentum guys are going to dump this thing again. You get much below $8, it's going to be a big problem. So I don't want to let's see here. I just want to pull it back up again. So what you have now is like, do I really want to buy this? Again, you can buy it now with those tight stops, but when you have a $10 stock, I mean, it gets up to $12. I mean, that's a 20% move. But you do have protection here, but down to $8 to $9, that's still a 10% loss. You get below, forget about the 100 days. I'm sorry, let me just get back to this thing. Bang. I don't want to talk out of both sides of my mouth. What I'm saying now is that if you like it, wait for it to break above its 50-day moving average. You'll miss a little bit. That's okay. I love, as I mentioned before, where you really make the big juice is a key turning points. Well, this isn't a key turning point. This is in the middle of the range. So we want to give ourselves a little leeway. If it breaks below that, it's going to be, you want to buy the calls. This thing's going to go to $16, $17 really quickly. That's going to be really bullish. But if this breaks below the lows of the 2 out of the last 3 days, which is, bang, $9, $9.72, breaking below $9.70. That's going to really raise the odds that this lower high is going to be followed by a lower low. The only reason why it bounced is because it got overbought. Again, not a good combination. Double top high, only bounced because it was oversold. Now it's curling back over again. But again, above 12, 50-day moving average, you're gonna jump into it for a nice run. I wouldn't really play it on the long side here until I'm willing to miss that move from 996 to 12 because I want to be sure it goes the upside. If anything, I'd play it from the short side with a 10% stop.
And there you go, making perfect time. It is exactly 2:00 p.m. Detroit time. Matt, thank you so much for spending time with us today. Are there any final words about the current state of the market that you might leave folks with going into Monday?
Yeah, I just say right now, I mean, the thing is that there's a lot of froth in the marketplace. The Fed is making a very subtle change, and it's to the hawkish side, not to the dovish side, despite what mainstream Wall Street is telling you. So the risk is, we're priced for perfection. Everybody's talking about the reopening and stuff. The problem is the Fed and the global central banks took the market way above its fundamental values. So it's time for the economy to play catch up because it's become incredibly overvalued. They'll probably meet somewhere in the middle now that the Fed is starting to raise, now that the Fed is allowing long-term interest rates to rise. Remember, they control short-term rates, but they also control long-term rates nowadays because of their QE programs. And if that happens, it also helps them take a little froth out of the market, which they are nervous about. They only talk about it slightly. So I'm playing things from a more cautious level. Got to be careful. Don't fight the Fed. The difference is, my opinion, is that fighting the Fed now is that they're slightly getting a little more hawkish, a little bit more tightening. And why would they keep things wide open if the economy is going to reopen? Then that the inflation concern that everybody's talking about is going to turn into runaway inflation, and that's not good for any assets. So play it from the cautious side. I think right now is going to be the best play. But because of options nowadays are much cheaper to buy. Number one, in terms of commission, they also have daily and weekly options, so that makes it much cheaper to play in those options. They also have inverse ETFs that you can play, and we cover those, especially in our tier 3, but in our other tiers, in tier 1 and tier 2 of the Benzinga Stock Picks report, and it really kind of will help people do more than just weather the volatility. It'll help them profit during it.
Wonderful. Thanks so much, Matt. You have a good weekend, man.
Thank you. You too. Thanks, Neil.
All right, guys, I'm going to stick around for just a minute. Matt just hinted at it. You can subscribe to Matt Maley's research, ongoing education, and stock picks so that you can earn while you learn. That link is in chat. If you have any questions about the subscription, I'll stick around for 5 minutes. 5 minutes to answer your questions. Got mostly crickets on the Zoom side of things. I'm looking on YouTube. Mostly crickets. Where is the link? The link is in chat. So if you're in chat, you should see the link. Posting again. Boom. I'll post it a bunch of times, so it's really easy to see. There you go. Oh, you don't see it? Hold on, hold on, hold on. I'm literally sending the link to one person. There you go. Did you guys get it? There it is 15 times, yeah. Wanted to make sure you guys got it. It start usually $97, but it's 30% off for people that are attending this webinar. Dang, I think there's one guy in this webinar named Jeremy that I think I've been like DMing the link to over and over. Well, Jeremy, I hope you bought it. What is the best sector to invest in for the next 3 months? Home building has strength. Um, Oil and energy still has strength. And consumer discretionary is starting to show strength. Oh, Webcoin. Thanks for the cricket emojis. I appreciate that. Well, we have this class again. Um, well, we try to do these about once a month for folks that really haven't subscribed to Matt's stuff, so they don't know what he's all about. And we like to give you some exposure, some free education, and then hopefully get you in. Because the subscription is dummy cheap. It's like $60 for an entire year. That's like cheaper than Netflix. And then once you get in, you get just nonstop like strategy calls and education and picks and stuff from him. Metals are also a good sector right now, Christopher. If you look at, I think it's XME, the metal ETF, looks really good. It's metals and mining. The price is normally like $97 for the first tier, and then it's about 30% off right now. See you tomorrow, Miles. Thanks for coming. I do recommend, guys, it is a 14-day money back guarantee, so I recommend getting at least the first and second tier so you can get some picks in. And then if you don't like it, you can get your money back. Just cancel. But at least get the first and second tier. Yeah, pharma is looking good, but it's harder to find momentum in pharma. Rita. The first tier is 67 and some change. And then when you add the second tier, I think it comes out to like, I don't know, like $200 a year or something like that. Just still like the cheapest you could ever get for stock picks, education, research, all that kind of stuff. It's kind of crazy. I don't have an opinion on Roblox. I don't know enough about it. I mean, I know about it fundamentally just because I am a millennial and I'm aware of games. But I haven't even looked at its chart once since it IPO'd. Jamel, Matt doesn't really have price limits on the stocks that he covers. There are no price limits. He doesn't like super expensive ones. He's not suggesting like Berkshire Hathaway. Almost everything is kind of more like, I think like the highest that he'll ever go is like an $80 stock, but they're usually cheaper because he wants to see big growth. What is the Benzinga Bootcamp? The Benzinga Bootcamp is a day of education that's completely free that we do once a month. If you go to benzingabootcamp.com, you'll find it. Tier 2, Tier 3. So Tier 1 is going to get you 2 picks a month. Tier 2 is going to get you 4 more picks a month, so you get a total of 6 picks. And then tier 3 is going to add a 3 times a week strategy call where Matt goes over like 9 picks. He references back to all the tier 1 and tier 2 picks, gives additional color on ways to trade around them, ways to trade option strategies around them. So really, I mean, if you want the full, I mean, it's designed so that it's easy to start, and then the second tier you're getting in more frequent trades, and then the third tier you're very actively involved in managing your money. In your trading. And the strategy calls are great. I mean, that's where that's where Mac, he'll make a call that's like, over the next 2 days, the stock I believe is about to do X Y Z. I'm gonna buy a call on it, and that's where you really get some big runners. Yeah, you see. So Sid says, I'm guessing that tier 2 and tier 3 show up after you sign up for tier 1. That's correct. You sign up for the first one, then you see the second one, and then after you get that one, you see the third one, and you stop whenever you feel satisfied. Jamel says, what tier is the $97 a month? There is no $97 a month tier. Everything is on an annual basis. And if I said $97 a month, that was a mistake, and I'm sorry. And there's a normally $97 a year subscription, which is the tier 1, but right now it's 30% off, so it's like 60 something per year for life. Yep, and you'll all the alerts that Matt is sending out, you can get via email and by text message. Benzinga Pro is completely separate for now. Hint, hint. All right, guys. I recommend, as always, just go ahead and grab it. Grab the tier 1 and the tier 2. If you don't like it, it's a 14-day money back guarantee. You just let us know. Let Rodrigo know, and he will take care of you. No questions asked. But I recommend trying it out. It's you. There's we designed this to be the best value on the market, and we don't want you to stay on it. We want you to learn everything you need about trading and investing to be self-sufficient, and then go on and do your own. Or if you want to just stay with us, we'd love to have you. But it's the education and the picks at the same time. In order to get tier 2, yes, you have to get tier 1. It stacks up. And if the link's not working for you, try it in a incognito window or using another browser, because I think the link is working for everybody else. And the SMS alerts or text alerts are free. All right, guys, I'm going to take off. Thank you all for attending. Rodrigo's in the chat letting you know that if you want to get a hold of him or if you have any questions, you can email or call him directly. That's part of what you're getting if you subscribe is the best darn customer support in the entire business. We got your back. Real people helping you out. Okay, guys. Yeah, thank you guys for your time. Happy Sunday. Going into Monday. It's going to be great. All right. See you guys.